Hello, ladies and gentlemen. Welcome back. Here's another case, again, an exercise case to practice our knowledge from value-added tax. So let's skip any nice introduction and directly hop to the case. This is now H from Hamburg in Germany. H is a private person and buys a car from his cousin in Italy, and that car is not yet 5 months old. The price on which they agree is €20,000, and H buys the car during a private visit to his cousin in Italy, travels home with it to Germany, and then has it registered with the competent authorities in Hamburg. Your task and my task is now to find out the correct VAT treatment of both people in both countries, and there is a variant. What would be the case if H were not a private person but a small entrepreneur? So the first question is again what happens here. So let's find out the contract relationships. So, well, we have H, a private person in Hamburg. He has something to do with cousin in Italy. That is the seller. H is the buyer. We have a contract. There is something sold from Italy to Hamburg. It is a new car. And for new cars, you remember there were special rules in the EU internal cross-border cases. And the essence of these rules were every buyer, even if he or she is a private person, must pay acquisition tax. That, on the other side, had then a formal consequence because sales and services are only taxable under normal principles if the seller is an entrepreneur. This is fictitiously dealt with by declaring the seller automatically to be an entrepreneur with effect for this individual special sale. So that's it. And now these principles must, or these results must come out, and there the approach of the system is you try it with the regular rules. However, if the regular rules do not bring that outcome, then you turn to the special rules of 1b, which say also the acquisition of a private buyer. No, buy a private buyer of a private buyer is some centuries ago has been abolished. So buy a private buyer. Then you take 1b, and if you have a seller which is not an entrepreneur, then you turn to paragraph 2a, which says for the purpose of delivery of a new vehicle, every seller is regarded as an entrepreneur. So that is, let's say, our initial framework, which shows us what must come out. And now let's go and look to the buyer's treatment. Taxability, we have to test 1.1 number 5, and I already mentioned paragraph 1b, so we should have a look. First, we should have a look if we can reach the necessary and right outcome with 1a, and then afterwards we would have to turn to 1b. Yeah, here we have 1a, the intra-community acquisition of a good, and that's a bit strange, sorry, here that's the right one. Number one condition is that the good must go from one member state to another one. That's the case in our case. And number two says the acquirer must be an entrepreneur or a juridical person. And that's not the case because H is not a juridical person and not an entrepreneur. That means under the 1a rules, the normal rules, the result which we want to get is not achievable. And so we have to turn to 1b. 1b is here. So 1b then says, okay, the acquisition of a new vehicle by an acquirer who does not belong to the persons in 1a is nevertheless an intra-community acquisition of good if only the first condition is fulfilled, so that the new vehicle goes from one state to the other. Now, to apply that rule, you must be sure what a new vehicle is, and here they say vehicles can be motor-driven land vehicles, vulgarly called cars, can be ships, and can be aircrafts, and they are new. In case of a land vehicle, if it has not been used for more than 6,000 kilometers, or if its first use has occurred not longer than 6 months ago. So if the registration date is less than 6 months ago, that's our case here. So that is the proof that we have to deal with a new vehicle here, and that the 1B rules apply, so that it is treated as an intra-community acquisition. So let's write that down into our case solution. So under 1B1, we saw that it's sufficient that a new vehicle goes from Italy to Germany to trigger intra-community acquisition tax. This car is indeed new. We found that out here, and so it is an intra-community acquisition. We still need the place of the acquisition that is determined under 3D as usual, where the transport ends. That was Hamburg. It's taxable, so in Germany. Is there a tax exemption? And the answer is we must remember that this is not the list of paragraph 4 as usual, but in case of acquisition tax it's 4B, and 4B is very short and has no exception for our case, so it's fully liable to tax. The tax base is the net amount. This is 20,000 because in the price paid there can't be VAT included because the customer has to pay it himself to the fiscal authorities, so it comes on top. The tax is 19%, so it's 3.8. The taxpayer is the buyer, as always with acquisition tax, and the tax point or the arisal of the tax is the day of the acquisition, 13.1 number 7, in case of the purchase by a buyer in the sense of paragraph 1b. An input tax for a private purchaser is not feasible, so that's an empty line in our solution. Now let's turn to the treatment of the seller. We already said the basic rule is every seller is treated as an entrepreneur. However, we want to be safe that this is indeed true. So let's have a look to the legal rules again. Here they are, the legal rules which we need. Suppliers of a new vehicle. The rule is short and brutal. Who delivers a new vehicle in the inland? So now this is the German rule. However, in Italy there must be a parallel rule because these rules are completely harmonized within the EU. So whoever delivers a new vehicle in the inland that is transferred into other parts of the customs territory of the community, so into other member states or their VAT territory, is regarded as an entrepreneur in the sense of paragraph 2 for this delivery if he is no entrepreneur under paragraph 2 USDG in the first place. The same applies if the supplier of a new vehicle is an entrepreneur but does not act in this quality. So everybody is deemed to be an entrepreneur for the execution of a sale of a new vehicle into another member state. That's clearly here. And that a private person, the customer, the cousin in Italy, is not a genuine entrepreneur under the rules of paragraph 2 seems to be clear. So 2a is our solution which we need to construct the taxability in Italy. So let's do it. Yeah, so the treatment of the seller in Italy, we have to test taxability there for the delivery. That's number 1, USDG, or instead of this, naturally, the Italian parallel rule to this rule in German law. The car seller is, though he is a private person, deemed to be an entrepreneur. We saw that just now. See paragraph 2a of German USDG. He acts, therefore, necessarily within the scope of his enterprise because he is deemed to be entrepreneurial activity. So for consideration, yes, he has himself paid. It's a delivery because the position like an owner is transferred to the cousin in Hamburg, and the place of delivery is because the good is moved during the transaction to be determined according to what is in German law 3.6 sentence 1, so where the movement of the good begins. That leads us to the terrible effect that this event is completely taxable under Italian law, according to the Italian parallel rules to the rules cited just here, so taxable in Italy. Now, if we have an intra-community acquisition on the side of the buyer, we usually have an intra-community delivery, which is tax-free on the side of the seller. And that should also be found here. So let's check. Intra-community delivery. Can it apply? 6A1. Yes, fulfilled. The car goes to another member state. Number 2. 6A1 number 2 says the buyer must be an entrepreneur or a juridical person, or in the case of a new car or new vehicle, every person whatsoever. That's definitively fulfilled. Age is covered by any person whosoever. So number 3, the buyer must be subject to acquisition tax in another member state. Yes, we found out age must pay acquisition tax in Germany. Then number 4, usually the buyer has to give a valid VAT identification number to the seller. However, private persons don't have one. Now, if we look to 6A1 number 4 more closely, we find that the VAT identification number is only demanded in cases where the buyer is a genuine entrepreneur under paragraph 2, not in the cases of paragraph 2A. And that means that condition does not need to be fulfilled. So we have here all first 3 conditions fulfilled. The fourth is not necessary in this specific constellation. So all conditions fulfilled. So intra-community delivery is in place. That means it is tax-free. However, we know from German law that the tax exemption is not granted if the recapitulative statement is not handed in correctly by the seller. However, that also only applies if we have a seller who has to hand in a recapitulative statement, and that can only be done if the seller is a genuine enterprise owner and the buyer is a genuine entrepreneur. So this condition does not need to be fulfilled here. So it's automatically tax-free. That brings along a question, by the way. Why do they play this game in making the private seller into an entrepreneur, telling him about taxability, then grant him automatically a tax exemption? Isn't that complicated? What happens if the seller, who as a private person is supposed to be an absolute idiot, doesn't hand in tax declaration? First thing is, it can't be tax fraud, because if you don't need to pay a tax, you can't do a damage to the state, and for not doing any damage, you are usually not punished. So probably that's not the case. However, if you go on, you see there is a tax base, and then you see there is no tax to be paid. And then at the end of our testing scheme, you come to the entry input tax claims. And then you find out, well, this guy was a private buyer. So when he bought the car for his private consume, he got no input tax refunded. And so let's imagine he bought the car for 30,000 in Italy, and let's say paid Italian VAT on top. Let's say, I don't have in mind at the moment how high the Italian VAT rate really is. Let's say it's 20% for the sake of good calculations. Then he paid 6,000 VAT. Now later he sold this car on to another consumer. And so this other consumer paid on the net price of 20,000 again VAT in Germany. So we would have a double taxation in the system. And that is what the law wants to avoid. So the idea is, if you are a private seller and sell on your private car, you should get your own VAT contained in the acquisition price when you bought it in Italy. You should get that back. However, if the price dropped between when you bought the car and when you resold it, then this decrease in the value of the car goes back to consume. You used this car here in this example for 5 months, and perhaps you parked it with 180 kilometers by hitting a wall, so it's strongly damaged or so, or it loses value. So naturally, the decrease in value during your consume time when you drove the car can't be refunded as input tax because that referred to private consume. So what the whole thing with 2A is about is that remaining net value which the seller gets for passing on that good to Germany, that entitles him to reclaim the Italian VAT referring to that net value. So if you paid 30,000 plus, let's say 6,000 Italian taxes, and you sell it on for a value of still 20,000, then you should get a VAT input tax refund claim. Now you want to get 6,000, however, the VAT input tax is limited to that Italian tax which refers to the rest value. So 20,000 times 20% Italian rate, you know that's a fiction, I just invented that rate to have a good calculation basis. So 4,000 you could claim back. That is the reason why the seller will never be punished for tax fraud if he doesn't know about his status and if he doesn't hand in a tax declaration or things like that. The only thing with 2A and what results from there is that the seller gets an opportunity to avoid a double taxation with VAT in his car, and so to reclaim that amount of Italian VAT which relates to the rest value which now leaves Italy and is so exported. If you want to read that up a bit more closely, then you can be referred to paragraph 15 German law, paragraph 4a or subparagraph 4a there. And as that is probably a bit complicated or strange, let's have a look there. So here we have it. 15.4a says for suppliers of a new vehicle in the sense of 2a, so for private persons selling on a new vehicle within the first, let's say, 6 months or before they have performed a fixed amount of minimum kilometers. So if they are still new and they sell it on to another member state of the EU, then input tax claims are modified as follows. Deductible is only the tax amount which refers to the delivery, importation, or intra-community acquisition of that new vehicle, not to anything else incurred by that fictitious entrepreneur. So not to legal services, legal advice, anything else. The tax can only be deducted up to that amount which would be due for the delivery of the new vehicle if that delivery were not tax-free. That's a decent way to say, okay, if the remaining value is only 20,000 instead of 30,000, then the Italian VAT which you can deduct is only the 20% on the 20,000, not the original 20% on 30,000, because the drop down in net value of 30,000 to 20,000 shows that you had a consume with a net value of 10,000 in the meantime. And for consume, there should never be a refund of value added tax, that's clear. And the input tax can only be deducted at that point of time when the supplier performs the intra-community delivery. Also, that seems to be clear, because before you sell on the new car to another member state, you can't prove that this car is not used entirely for internal consume in Italy by a private person, but will be taxable again for a delivery. That is why you have these conditions here. Well, after that is said, let's go to our case back and look to what happens if the variant applies. Okay, now let's talk about the variant. The variant was that, you remember probably, H was not a private person but a small entrepreneur. And a small entrepreneur does belong to the set of persons which are covered by 1A. So 1B is not necessary. 1A, however, says a small entrepreneur is only taxable with acquisitions if the acquisition threshold is surpassed. And that would be surpassed here, because 12,500 is the German acquisition threshold, and so 20,000 is higher. However, even if you are a half entrepreneur, so in this case a small entrepreneur, and the acquisition threshold is not surpassed, there is a special rule that for the acquisition of new vehicles, the threshold doesn't count. So here, from the first euro onwards, a small entrepreneur and any other half entrepreneur classifies automatically for acquisition tax. Then such a person needs a VAT identification number. That's the difference to the previous case. And, well, all the rest is the same. So nothing else would change, and that is, let's say, enough for this example. So let's terminate this case for today, and I thank you for watching it, and see you soon again for the next exercise case. There are going some 5 or so still to come, and then we go on with additional contents in the cross-border chapter. Okay, goodbye till next time.